Well, guys, generally I like to talk a little bit more about specific stocks and what's going on with specific stocks in the stock market. But today I want to do a little video about the stock market in general. And are you being ripped off if you are investing in the stock market right now? Or is the stock market a great deal right now? I want to go through some different charts with you. I want to show you some different statistics, and I want to give you my full opinion. By the way, this is a financial education channel. If you are new here, I am Jeremy. Let's start getting into this, guys. So I think it's an interesting subject on a day like today when the Dow's back over 26,000 today. The Nasdaq's getting close to an all-time high once again, just a few hundred points away at 7750 right now. We have the S&P 500 well over 2,800 once again. And if you look, the stock markets have absolutely been on fire, okay? If you look at just the Dow, basically since, just before the new year started, it's just been up and away pretty much for the past 3 months. It's been incredible, all right? You can look at the Nasdaq, you can look at the S&P 500. It doesn't really matter what you look at for the indexes. They've just been on fire the past few months, all right? Now, it was really rough. Let's be very honest. The fall time was horrible. October, November, going into December, the markets were really rough. They had dropped a massive amount. They had probably sold off way too much. And if you got to buy, then that's great for you, as I did. A lot of us were buying in the markets, and we ended up, obviously making a lot on our shares we bought during that time. But needless to say, the markets have come back a lot, and it's kind of like, are we at a place now where you're kind of being ripped off, or the market's still a good deal, okay? So, it's fun to look at these charts. It's so fun to look at a chart of the S&P 500, the Dow, and look at how much it went up. Oh, look at how much it's gone down and whatnot. But in reality, that tells us very little about if you're getting a good deal on buying stocks in general, okay? All it really tells you is buyer and seller momentum, How many people are out there really just, mass selling shares, or how many people are mass buying shares? Do you have a lot of buyers in the market, a lot of sellers in the market? Where's the pressure at? Is there a lot more pressure on the sell side or the buy side? That's really all that those charts show us in the end. That's really all you can decipher. And obviously, the past few months has been a massive amount of pressure on the buy side and, way less pressure on the sell side. And that's how you get the markets to just go up and up and up, okay? So the question is, how do we value if the market is a ripoff or if the market is a good deal, okay? There are a few different ways you can kind of go about doing this. One of the ways I like to decipher whether the stock market in general is a good deal or is a ripoff is one of the ways I like to do it is looking at the price to earnings ratio. Now, for those of you who do not know the price to earnings ratio, I have it here at the definition straight from Investopedia, all right? The price to earnings ratio, otherwise known as a P ratio, by the way, I mention this all the time on the channel. I talk about P ratios all the time, is a ratio for valuing a company that measures its current share price relative to its per share earnings, otherwise known as EPS. The price to earnings ratio is also sometimes known as a price multiple or the earnings multiple, all right? If you want to read a little bit more about it, you can there. And so if I'm looking at the markets in general, one of the ways I like to look at it is what is the P ratio for the markets in general? If I'm valuing an actual stock, one of the ways I like to value that stock is what is its P ratio? What is its P ratio versus its peers? What is its P ratio on a historical standard? What is its P ratio based upon, what I expect that company to grow in the future, okay? But if we're looking at the markets in general, I just want to know, what's the P ratios kind of on the market in general, specifically the S&P 500. I think that kind of gives me the best opinion. The Dow, you can look at the S&P 500, but it's only 30 stocks. S&P 500, you're really getting the 500 biggest companies out there, and so that's the one I really like to look at. And if we look at it right now, we're at somewhere a little over a 21 P ratio right now on the markets, okay? A little over a 21 P ratio. Now, back in January, after that massive sell-off and whatnot, we were at around a 19 range. So if we look at this on a 5-year basis, which I love to kind of look at on like a 5-year basis, what's happened over the past 5 years, we're going to see that currently the P ratio is higher, which would be a bad thing. The P ratio is higher right now than it was in 2014 and 2015, all right? However, it is lower than 2016, it is lower than 2017, and it is lower than 2018, so that's a good thing, okay? So we kind of get in a mixed picture there. It's good in the sense of, hey, we were lower than a couple years, 2014, 2015, but we're higher than 2016, 2017, 2018, okay? So you're kind of getting a mixed picture there, but needless to say, we're somewhere in the ranges of kind of where the P ratio should be, at least on a 5-year standard, okay? Now, if we look at a time when the market was massive massively overvalued. That would be anywhere from the 1998 to like 2003 time period. The stock market during that time was just massively overvalued in my personal opinion. I mean, if you just look at the PE ratios you had to pay at any of those years, we're talking anywhere from a 24 to like a 46 type range. Like, if things had gotten really out of whack in the stock market in the early 2000s, we had the whole dot-com bubble that ended up bursting in 2000 and whatnot, and the markets just got crazy hyped about the internet things and whatnot. And so if you look at that, you know, you can obviously tell the markets were massively overvalued at those particular times, at least on a short-term basis, okay? But the PE, it doesn't tell us the full story, okay? As much as I love to look at PE ratios, and as much as I love specifically looking at stock PE ratios relative to peers, relative to historical standards, we've got to be honest, it does not tell us the full story. How do we know that PE ratios don't tell us the full story? Well, pretty simple. You could just go back prior to the Great Recession, okay? PE ratios look like the markets were a pretty decent deal, okay? If we look at 2006, we had a PE ratio of what, 18? If we look at 2007, we had a PE ratio of what, 17? You know, so you could have looked at the markets in 2006, you could have looked into the markets in 2007 and said, hey man, the markets are pretty cheap right now. The markets are pretty cheap right now. Let me, you know, stick a lot of money in the stock market. Now, obviously, that was completely false, right? Because when the economy ended up crashing and most stocks ended up losing, you know, 50% of their value. Some stocks lost way more than 50% of their value in a very short amount of time. So you can't just look at PE ratios when you're kind of thinking about the markets in general and where the markets are kind of trading at and whatnot. You also need to think about where is the U.S. economy at, especially if you're looking at U.S. stocks, obviously. Where's the U.S. economy at, all right? And especially in relation to the cycle of where the U.S. economy kind of goes in cycles, okay? And the way I would describe it is, you know, everybody grew up probably drinking Capri Suns as a kid every once in a while. Capri Suns are these like little foldable things, and I kind of think about the U.S. economy as a Capri Sun. You're drinking that Capri Sun and you're sucking that thing down, man, you're squeezing it, and you know there's a little more juice left in there, but you're not sure how much because you can't see into the thing, and you're squeezing it and you're drinking it, and it's like there might be a little juice left in here. And that's the U.S. economy right now. There's a little bit of juice left in it, but we don't know, is there enough juice to maybe carry it for a few more months, a few more years? We don't know, but what we do know is we're toward the end of the cycle, obviously, rather than the beginning of the cycle, okay? The recession ended in 2009. It was a very slow recovery, obviously. A lot of people still felt we were in a recession in 2010, even though statistically we were not, into 2011. But 2012 coming out, you know, the economy got stronger and stronger, and we've been in a pretty good economy for quite a while now. Meaning that basically, as far as if you look at the credit cycle and things like that, and just the economic cycle in general, we're toward the end. We just don't know if it's a few more months toward the end or a few more years, but needless to say, we're closer to the end than the beginning. Let's put it that way, okay? So in my personal opinion, now is a time when you've got to be very picky, like a little kid with eating vegetables, okay? You got to be very picky with your stock investing decisions at the moment, okay? This has got to be a time when you are only investing in the best of the best companies that you believe in the most for the long term, because it's not a time where you just want to be throwing money around at any stocks. There are times in the stock market where you can basically just flood money out at whatever stocks you want and you'll make a lot of money, okay? If you had a ton of money in 2009, right? And you had a ton of money in 2010, which I certainly did, and I had like a few $100 or $1,000 or whatever. But if you had a ton of money to invest at that time and you went in the markets, obviously, like you could have put your money in almost any stock and you would have made huge gains on those stocks from basically where they were at then to where they're at now, or even in the few years after that, right? But right now it's a different scenario because we're toward the tail end, obviously, of an economic cycle. The PE ratios are in a fair valuation type area, I would say right now. So you want to be very picky with your investing decisions, more picky than you've been ever in the past, in my personal opinion. Only stick money in the very best stocks you feel that have the most potential for upside and are the most undervalued right now. Do not just flood money out there in the stock markets in 2019, because I'm just telling you, if you're looking at this like the Capri Sun's going down sooner or later, okay, sooner or later there's going to be no juice left in it, and we just have to have a reset. You have a recession, and then you start coming out of that again, okay? It's just the way things work, okay? So in my opinion, you just got to be very picky with your stock market investing decisions right now. I can't say you're necessarily getting ripped off if you invest in the stock market. I definitely can't say you're getting a good deal right now. It's somewhere in between, but what I can tell you is sooner or later, we're coming upon the time when, things will end sometime soon. It could be a matter of months, could be a matter of a few years, but needless to say, sooner or later, we're going to have a reset on this thing. Markets will drop pretty big, maybe a 20% downward move, 30% downward move. Maybe they'll be down for a year or two or something like that, and you kind of got to reset. And that's why you want to be sticking your money only in the best stocks possible right now, and not just flooding money into the markets, let me put money in whatever stocks right now. In my opinion, you just don't want to do that at this particular time. You want to be very, very deliberate about where you put your money right now, guys. So I hope you enjoyed this. I hope you learned a lot from this on kind of the way I think about the markets in general and how they are valued. Let me know your opinion down there in that comment section. Do you think it's a time where you should be selling stocks? Do you think it's a time where if you're investing, you should be very picky? Do you think it's a time where you should just be able to throw money around at any stock and you'll make money? I would love to hear your guys' opinion down there in that comment section. As always, thank you for watching and have a great day.